over the past 5 years, banks have had to increase their core capital as the central bank sought to ensure banking stability. But of course, it would seem that there is no rest to be seen and heard, and banks now have a herculean task ahead of them. And Adelaide Changole takes us through what the new core capital is all about and how it's going to affect banks across the country on our first edition of Cause and Effect.
For banks, I propose to increase the minimum core capital progressively from the current 1 billion to 5 billion by December 2018.
With that announcement, CS Rotich laid the groundwork for a complete shift in Kenya's banking landscape. The argument he gave was sound, especially in light of the 2008 global financial crisis that threatened to topple the world economy.
Kenya needs to have a strong, well-capitalized financial institutions which are not only able to participate in financing the large projects envisaged in Vision 20, but that are also well-capitalized to withstand financial shock and crisis.
If you are in this industry, you need to have the capital backing so that not only are the government confident that you will not default on your depositors, and that your depositors are also confident.
Incidentally, all of Kenya's listed lenders are already compliant, with KCB having the largest core capital of 58 billion shillings as at the end of last year. But the hardest hit will be the 22 smallest banks in the country, among them KREP, Habib, Victoria and Equatorial banks, who have core capital of between 934 million shillings and 4.6 billion shillings.
Because we are highly fragmented as an industry with over 44 banks in a small economy, you get a lot of subscale banks. So it's a good thing in terms of the macroeconomic perspective.
So we expect to see a lot of acquisitions, a lot of mergers coming in so that banks can be able to meet the requirement. We also expect to see banks entering into various finance-raising measures to be able to raise the capital required.
The state is looking to borrow from countries like South Africa and Nigeria, which have fewer, stronger and better financed banks. And it would seem that players in the banking sector are not averse to these ambitions.
So it creates scale, it creates banks that can take on big projects and overall a positive impact on the economy.
In fact, Munir says the government will need to scale up the core capital requirement even further in the future.
With 5 billion, you're still talking about over 20 banks in this economy, and that still is a large number. So it's still room for raising that to a level where we've got a reasonable number just within 5 to 10 banks.
Interestingly, while Treasury and the banks appear to be reading from the same script, the governor and deputy governor of the central bank have a different opinion. They say the move is perturbing since the economy needs different types of banks to serve the diverse needs of the market. And ironically, they say the move could bring about a lack of diversity that could hurt Kenya's ambition of becoming a financial hub.
Small banks may have niches that, as you mentioned, that are being served by them. Once they are consolidated into a bigger bank, the bigger bank may not be interested.
We need different financial institutions to service different aspects of our economy.
Instead, they say the banking system as currently structured does not adequately meet the needs of the market, and as such, the only solution lies in restructuring it.
First, we have to understand where is the country going, what is our vision, what is our goals, and then from there, determine what kind of support that vision needs from the financial and banking sector, and then start structuring our banks to support what it is we're trying to achieve.
Regardless, it would seem the winds of change are blowing the way of banks, and only time will tell if these changes yield the expected results. Adelaide Changole for Cause and Effect.